Question 3 says, refer to part C. Using the information provided, calculate the taxable income for Pump House for the 2020 year of assessment. You are required to show all your calculations and explanations or references to the Act to support your answer. You are required to start your calculation of the profit before tax figure calculated by the accountant. Okay, so that's important. Part C, or question 3, sorry. That's actually probably more correct. Sorry guys, I should have actually just in the required called it part A, B and C from the start. I should have called it question 1, 2 and 3. Description. Calculation and explanation. CGT and rands. Okay, so what did the accountant calculate as the profit before tax? 80,62644. Okay guys, I'm going to just put that down, whatever the profit before tax is. This might be a little bit different by the time that you get your solution. That amount might be a little bit different, but basically start with whatever is there. Okay, now I suggest we start from the top and we fix everything. We have also in any case note number 1. Okay, so the first thing that we saw was local sales. There will be no issue. So local sales, there was no problem with that. They've added it, we would also add it, so we're not going to make any adjustment. The export sales is a problem. The export sales are 0 rated. So if you've invoiced them a total amount of 3,072,000, but that amount actually there should have been 0, then the amount that you should include for revenue is the same as the total invoice amount. So they've only included that amount. So how do we get it to that amount? By adding the VAT, 400,739. Okay, then we have this rental income and the cost of sales, and I'm going to just make a comment here. I'm just going to write it here. Rental income, flats and guest houses, no adjustments for either of those amounts. Cost of sales, they don't give us any information. Cost of sales is basically usually the same, the way it's calculated. For tax we do the same. Right, so no real issues over there. Then we have note number 2. Note number 2 is the forex loss of 5,250. So first thing we do is let's eliminate that forex loss. Because we're going to calculate our own. Add back 5,250. Then I'm going to do section 12C. Let's get this out of the way as well. This is now the cost of the tanks. The cost of the tanks is $1,500 times 10 times what date, guys? Always the transaction date, so 1671. Then there were import duties of 150,000. right, and you would get section 12C for this. Of course, it's used as manufacturing. They give us section 11E there, but you need to know that you need to use section 12C. Okay, sorry, and that needs to be a deduction. So now, let's do all the forex. So the first thing I'm going to make a comment is forex gains and losses occurred in 2019. However, asset only brought into use in 2020. Thus, section 24I7 applies. 2019 gains, losses must be included in 2020. Okay, so forex 2019. First one is the creditor. So now you have to go back and think about what happened in 2019. In 2019, we calculated the forex gain or loss between transaction date and translation date. So transaction date, we thought we were going to pay 1671. Translation date, we see we pay 1720. So that's a forex loss for us. So it's 1,500 times 10 times, I like to put the most recent date down first, minus 1671. Okay, then we have the FEC. The FEC goes from 1685 to 18.60. So we say, I took it out when it was 1685. That's how much I'm going to pay. If I had taken it out today, I would have paid 1860. So I'm paying less because I took it out earlier. So that's a forex gain for me. Okay, so 26,250. There we go. We'll do the next one just in a different color. Forex for 2020. Let's do the creditor first. So the creditor, this is what we restated at last. Now we're doing it between transaction date and realization date. So the last time we looked at it was 1720, it's now 1601, so we've made a forex gain. FEC, the last time we looked at it was 1860. We now have to use the spot rate. So we see basically what we're saying as we're saying, the last time we looked at it, we thought we were going to pay 18. We should have paid 1860. If we had taken it out today, if we hadn't done it, it would pay 1601. So we've made a loss here. Or in other words, yeah, we restated it. We took the FEC from 1685 to 18 Rand 60. So we restated that instrument. We increased it in value. So that's an FEC. Now we're decreasing it again. Okay, however you view it, however you've studied it, also in accounting, that same logic applies. 38,850. Now we can perform a quick spot check to see if we are correct. So if I add up all of these things, I get minus 2,100. Okay, you can check that. If I then see what I originally thought I would pay on transaction date, it was that 250,650. Okay, 250,650. Guys, this is the cost on transaction. So 1,500 times 10 times, what's that, 1671. Then I compare it to what I actually paid. Well, spot rate on payment date. So realization date. So 1,500 times 10, and what was the spot rate? 1601. Sorry, man. Not the spot rate, what I actually paid. I'm tricking myself here now. I was actually first correct. Okay, you have to check what you actually paid. And what did we actually pay? We pay the 1,500 times 10 times the rate in the FEC, 1685. 1,500 times 10 times 1685 is 252,750. So can you see, if we, on transaction date, the 1st of August 2019, we thought we were going to pay 250,650, but we ended up paying 1,685. That's the FEC rate. The difference there, 2,100 rands, which is the same as over there. Okay, so that's how you do the quick check. But remember, you have to then see the Forex for the entire period, 2019 and 2020. If you're only doing one of the years, it obviously won't work out. Okay, then note number 3 is the depreciation, 2,510. So before we go crazy with that and just add it back, let's actually add it back. I think actually it's a little bit safer. So if you say depreciation, we add it back. Right. 2,510. Manufacturing assets and factory buildings. Okay, there's nothing to do with those guys. Then the guest houses. Purchased in 2000. 5 years. It's now 2020. 20 years. So we should still be doing it. Section 13 Quin. Right, but what's the issue here? This was purchased in 2000. Section 13 Quin. Only for assets on or after 1 April 2007. Okay. And then we have the flats. The flats were purchased prior to the 2020 year. Okay, we can see they're not fully written off yet. So, flats, section 13.6. It's a nice little deduction there. Okay, then they say new flats are purchased 30 for 18 million. So the first thing I want to do is check the residential unit of its low cost residential units. So cost per flat. Well, actually, before we do that, total cost, let's work it out, is the cost X VAT, which they give us, right? 18 million plus the VAT, because it's exempt, section 12C. We can't claim it. So 18 million times 15%. Cost per flat. Right, so 690,000. So it exceeds 350,000. It is not low cost residential units. So section 13.6. $690,000 times 30, or you can use 20,700,000. Okay. And then we have profit on disposal of an asset of 5,000 rands. Or rather, okay, sorry guys. You'll see that this figure is also different. Loss on disposal. I'm going to make it a loss of 13,000. Okay, again, you'll see it a little bit differently in yours. You won't even notice. It's just as I'm also doing this question and then picking up inconsistencies. Okay, so there's a 13,000 rands loss there. That's what I want you to see. So what that means for us is, the first thing we're going to do is we're going to take the loss on disposal. We're going to add it back. It's an accounting entry, and we can't use that. So we add it back. Now we do the disposal of the computer. So the first thing we start with is the cost. Now they tell us that in this question, the computer had a cost of 69,000 rands. How much VAT did we claim? We claimed 69,000 times 15 over 115 times 75%. Why times the 75%? Because remember, 75% is taxable of this business. 25% is exempt. We're using this in the accounting department. Okay, so 6,750. So this gives us the cost for income tax. This is what section 23 capital C tells us to do. 6,250. So that's our cost. So now we say less our section 11E allowances. This computer was brought into use when? 1 October 2018. So 6,250 divided by how many years? 5 years. October, November, December. So times 3/12. Then in 2019 we used it the entire year. And in 2020 we used it for how long? On the 1st of April it was sold, so we used it for January, February, March. Okay, very important here guys. This figure you must show as a deduction in the current year. This gives us a tax value when sold. Okay, I'm just going to write this down quickly. The sum of all of these allowances is 18,676. So that means the tax value we sold is 43,574, right? Then our selling price limited to the original cost. How much did we sell it for? 47,000. That's excluding VAT. That's correct. Remember, we would raise 100% VAT on it. So that gives us a recoupment. $3,426. Wait, sorry. So our capital gain is the proceeds, 47,000 minus the recoupment, 3,426, gives us 43,574. The base cost is the cost. Guys, this is the cost that we use. So 6,250. Less allowances, which is at 18,676. Gives us 43,574. So there's no capital gain. Okay, then we go back to the question, and the last thing we have to do here is other tax deductible expenses. And there's obviously nothing to do there because they say it's tax deductible, so we just say no adjustments. Right, then you can add up everything, guys, and that will give you your taxable income. And that's it. I hope you enjoyed doing the question.